Welcome back to Investing Talk Podcast.
Today we're looking at EON resources.
As usual, before we start, subscribe, like, and comment to this video to support the show. And we are really thrilled to have you with us today, whether you're prepping for an upcoming investment committee meeting or you're just tracking the nuances of the energy sector, you're in the right place.
Yeah, it's a really fascinating time to be looking at independent oil and gas.
Exactly. Our mission today is to examine the underlying mechanics of independent exploration and production. We want to see how a smaller player actually attempts to carve out a defensible niche in the massive Permian Basin.
Right, because it's a heavily saturated market.
Oh, incredibly saturated. So we're going to look closely at their capital allocation, how they leverage capital-intensive secondary recovery methods, things like water flooding, to maximize their output, and what the intersection of their market momentum and macro events might signal for their future.
Which is really where we have to start. The broader macroeconomic context is mandatory if you want to fully grasp what's happening with a company like EON Resources.
Let's dive right into the fundamentals of this. Setting the macro stage here, it's early March 2026, and oil has just pushed past the $80 a barrel threshold.
Right, and looking at the data impartially, a huge quantifiable driver of that specific price action is the ongoing geopolitical tension in the Middle East.
The conflict risk premium.
Exactly. The market is pricing in that risk premium right now. Whenever you see sustained uncertainty or, the elevated potential for a major supply disruption over there, the global benchmark price reacts immediately.
And then capital starts scrambling.
Yes. Institutional capital and market attention immediately begin rotating back into domestic oil plays here in the United States. They're searching for secure, onshore production that isn't reliant on vulnerable shipping lanes.
Which completely changes the math for domestic producers. When that global risk premium inflates the price of a barrel, the profit margins for established onshore operators just widen significantly.
They expand overnight, yeah.
So looking at EON Resources specifically, they operate exclusively in the Permian Basin, concentrated in the Northwest Shelf and Lea County. And the research notes they're currently producing over 1,000 barrels of oil equivalent per day. That daily production is coming from a network of 750 producing and injection wells.
Spread across 20,000 leasehold acres.
Right. 20,000 acres, that is a serious footprint for an independent.
Well, hitting that 1,000-barrel-a-day metric doesn't just happen by accident for a company of this size. It requires a really deliberate strategy of scaling through acquisition rather than wildcat exploration.
Because exploration is just too risky.
Way too risky. Their foundational asset is the Grayburg-Jackson field, which gave them 342 producing wells across roughly 13,700 acres. But what really deserves attention is their strategic maneuvering after that. In June of 2025, they executed a bolt-on acquisition, bringing the South Justice field into their portfolio.
And that added another, 130 wells?
130 producing wells and over 5,000 acres to their operational base, yes.
Now, the term bolt-on is heavily used in private equity and corporate strategy, but in the oil patch, its value is entirely dependent on geography.
Absolutely.
You can't just buy a random field 300 miles away and call it a synergy. You need it close. And the research highlights a vital detail regarding their setup. They hold a 100% working interest in contiguous acres.
And that contiguous nature is effectively their primary competitive moat. In this sector, land fragmentation is a silent margin killer.
It'll bleed you dry.
It really will. If your acreage looks like a checkerboard intertwined with leases owned by supermajors or rival independents, your overhead skyrockets.
Right, because you're forced to negotiate right-of-way for every single pipeline.
Exactly. You have to build redundant surface facilities, coordinate these incredibly complex gathering systems. But because EON's 20,000 acres are physically connected, their per-barrel lifting costs drop significantly.
They can just centralize everything.
They centralize their fluid handling, optimize road networks, and utilize shared infrastructure across the entire asset base without ever asking a neighbor for permission.
That operational autonomy brings us back to that 100% working interest detail. Owning 100% means they capture all the upside, but as a skeptic, I have to point out, it also means they shoulder 100% of the capital expenditure burden. During a commodity down cycle, having no partners to share the financial pain can be devastating. Why take on that level of concentrated risk?
It comes down to ultimate control over the capital expenditure dial. When you have joint venture partners or minority interest holders, every major financial decision is a negotiation.
Right.
If oil drops to $60 a barrel and you want to pause drilling to preserve cash, your partner might disagree and force the issue. They can compel you to spend capital you'd much rather conserve.
Ah, I see.
So holding 100% allows their management team to instantly pivot their strategy. They control the pace of development, the timing of shut-ins, and the scale of their infrastructure investments without any external friction.
Plus, operating proven reservoirs in the Permian largely insulates them from federal drilling bans threatening other jurisdictions.
Exactly.
So let's look at how they are actually allocating the capital generated from that autonomous setup. The financial strategy is pretty stark. They are not paying out dividends, nor are they doing share repurchases.
No, not at all.
Every dollar of free cash flow is being aggressively redirected back into the dirt. They are prioritizing reinvestment over immediate shareholder returns.
Which is an absolute requirement given the specific physics of their extraction method. They rely heavily on water flooding to maintain that 1,000-barrel-a-day output.
Right, secondary recovery.
Exactly. It's crucial to differentiate this from primary recovery. Primary recovery relies on the natural initial pressure of the underground reservoir, but that depletes rapidly.
Leaving the vast majority of the oil just trapped in the rock.
Right. To arrest that decline curve, you initiate secondary recovery. You pump water into an injection well to artificially repressurize the formation and basically sweep the remaining oil toward a producing well.
Which is intensely capital heavy. You are essentially building a subterranean factory. You need high-capacity pumps, extensive pipeline networks to handle corrosive fluids, water treatment facilities.
It's massive fluid handling logistics. The injection-to-production ratio in a mature waterflood can be staggering. You might be moving 5 or 10 barrels of water just to sweep 1 barrel of oil to the surface.
Wow.
So managing those lifting costs requires a hyper-efficient operation and deep pockets. This is why their capital allocation strategy makes perfect sense.
The August 2025 prospectus implies they have the stable liquidity required to sustain this loop.
They use cash flow to fund the heavy infrastructure, which accelerates revenue from legacy wells.
Precisely.
Let's shift gears and look at the technicals and sentiment, because the market appears to be recognizing that exact cash flow loop.
Looking at the real-time trading data, specifically that window between March 3rd and March 6th of 2026, EON Resources began triggering various algorithmic scanners. They appeared on screens for most active stocks, exhibited unusual volume, and were flagged as notable movers in both pre-market and after-hours sessions.
And the underlying data surrounding those scanner alerts offers a really fascinating lesson in market mechanics. The quantitative sentiment score attached to the top news stories for the stock during that exact high-volume period was registered as a flat 0.
Mathematically neutral.
Completely neutral.
It's incredible how algorithmic aggregation can create massive blind spots for retail investors who just read surface-level metrics. A stock experiencing a sudden, uncharacteristic surge in volume is rarely neutral.
Right, the discrepancy stems from how natural language processing algorithms parse financial news. The stories triggering those scanners were not subjective analyst upgrades.
They weren't opinion pieces saying strong buy.
Exactly. They were automated, quantitative alerts simply broadcasting a mathematical deviation in trading volume. The algorithm reads a volume alert without an accompanying editorial opinion and just scores it as 0.
But volume is the footprint of money.
Always. When you see uncharacteristic volume accumulation in an independent Permian operator, perfectly timed with crude oil breaking above $80 and a broader sector rotation into energy, that neutral score is deeply misleading.
It strongly implies a bullish undertone and breakout momentum.
Without a doubt.
And we actually have the SEC filings to corroborate that structural accumulation. The research points to Schedule 13D amendments and 8K filings submitted back in September or October of 2025. A 13D isn't a passive investment vehicle. It's required when an entity acquires beneficial ownership of more than 5% of a voting class of equity. That is a loud regulatory flare signaling that institutional money or significant insiders are taking a controlling interest.
And the presence of those filings, specifically the amendments, suggests a sustained accumulation phase. Institutional investors rarely build a position of that magnitude in a single trading session.
They'd spike the price against themselves.
Right. They utilize algorithmic execution to slowly absorb shares over weeks or months. While the research doesn't provide the granular trade-by-trade breakdown you'd find in a Form 4, the existence of cluster buying establishes a really strong foundational floor under the stock.
The smart money positioned themselves in late 2025, Probably anticipating the exact macroeconomic environment we're seeing unfold now in the spring of 2026.
Very likely, yes.
That raises the question of their exit liquidity, or rather, what specific catalysts that institutional money is waiting for to drive the valuation higher. The immediate hurdle is the Q1 2026 earnings report.
Absolutely. Sustaining a production rate of over 1,000 barrels a day is one thing, but proving they can maintain their margins and manage the lifting costs of that waterflood operation in an $80 oil environment, that's what will validate their cash flow projections.
The earnings report will serve as the ultimate stress test.
It will. And beyond earnings, there's the broader macro catalyst of potential interest rate cuts. The exploration and production sector is exceptionally sensitive to the cost of capital.
Right. If central banks initiate a rate-cutting cycle, the cost of servicing debt and funding the capital expenditures required for water flooding drops.
Which immediately improves the bottom line for debt-carrying independence.
Let's shift to the company-specific catalyst, because this is where the speculative upside gets really interesting. In a September 2025 presentation, EON announced the farm-out of their San Andres horizontal drilling rights.
Yes.
That maneuver has catalyzed a significant amount of chatter regarding future mergers, acquisitions, or major strategic partnerships. For the listeners who aren't familiar, what exactly is a farm-out?
A farm-out agreement is a highly strategic financial instrument. In this scenario, EON owns the drilling rights to the deeper San Andres formation beneath their acreage. But instead of taking on the massive capital risk of drilling horizontal wells themselves, they assign those rights to an outside third-party operator.
They let someone else take the risk.
Exactly. That outside operator agrees to fund the capital expenditure. They pay for the rig, the crew, the completion of the well. In exchange for providing the land and the rights, EON retains an overriding royalty interest or a reversionary working interest in whatever oil is ultimately produced.
So they are essentially monetizing the deeper rock without touching their own balance sheet. If those outside operators drill dry holes, EON isn't saddled with the debt of a failed exploration program. But if those horizontal wells are highly productive, EON gets a percentage of the revenue, which falls straight to their bottom line.
It provides massive upside leverage while protecting their core cash flow from the shallow waterflood operations. It's an asymmetric risk profile that makes them an incredibly attractive target.
Because the deep zones get de-risked on someone else's dime.
Right. If a mid-tier producer or a supermajor is looking to acquire contiguous Permian acreage, a company like EON that has already de-risked the deeper zones becomes a premium buyout candidate. The farm-out acts as a geological proof of concept.
Which totally justifies the current M&A speculation surrounding the stock.
Completely.
Okay, I want to transition into the risk section here. Because leverage always cuts both ways. We have to genuinely stress test this setup.
We do.
The most glaring macro risk here is oil price volatility. The current $80 price tag is heavily supported by the geopolitical risk premium in the Middle East. If diplomatic channels suddenly open or tensions de-escalate and supply fears evaporate, that premium could vanish overnight.
Commodity markets are ruthless in their mean reversion.
Right.
If the geopolitical landscape stabilizes, we could easily see the global benchmark drop back into the 60s.
And in that scenario, the margin of error for a company running an aggressive acquisition-heavy model compresses significantly. They just deployed capital to bolt on the South Justice Field.
Right.
While owning 100% of the working interest gives them operational control, it also means they have no partners to absorb the shock of a sudden revenue contraction.
Debt in a falling commodity market is toxic, especially when your primary extraction method involves the high lifting costs associated with fluid handling and water flooding.
The execution risk here is paramount. If their funding falters, or if the natural decline curves of the legacy wells outpace the secondary recovery efforts, the balance sheet could become severely strained.
The execution risk is absolutely the primary headwind. However, this highlights exactly why the farm-out strategy we just discussed is so critical. Management is clearly aware of their balance sheet vulnerabilities.
They are building a firewall.
Yes. By offloading the capital expenditure of the expensive horizontal drilling programs to third parties, they are proactively building a firewall around their core financials. They're hedging their growth strategy.
It doesn't eliminate the macro risk of falling oil prices, but it significantly mitigates the internal risk of an exploration program bankrupting the company during a downturn.
Exactly.
So let's synthesize our analysis and outline the final verdict presented in the research. Weighing the contiguous Permian acreage, the established cash flow from the water flooding operations, the aggressive institutional accumulation, and the macro tailwinds against the inherent execution risks, The research assigns EON Resources a bullish score of 7 out of 10.
A 7 out of 10, which reflects a highly constructive outlook tempered by the realities of operating a microcap in a capital-intensive industry.
It's a realistic score.
It is. The final investment thesis positions the stock as a highly leveraged play on the Permian Basin. Driven by management's track record of consolidation and their tight control over a unified land position, the analysis views the stock as a compelling swing trade candidate over the next 3 to 6 months.
Heavily dependent on the execution proved in the upcoming Q1 earnings.
Absolutely.
For you listening and tracking these mechanics, EON Resources serves as a masterclass in how independent exploration and production companies attempt to survive and scale in the shadow of the supermajors. They don't achieve scale through random exploration. They achieve it by meticulously assembling contiguous blocks of land, deploying advanced secondary recovery physics to extract every possible drop of value from mature assets, and you...
It's a highly specialized, ruthless game of margins and capital efficiency. It requires intense financial discipline.
It really does.
And as we wrap up, there's a broader structural question worth pondering here. We've just examined how a highly successful growing operator in the most prolific oil basin in North America is relying fundamentally on secondary recovery, pumping millions of gallons of water into the earth just to maintain production from aging fields.
Right.
If this level of capital intensity and infrastructure is what it now takes for a top-tier independent to thrive in the Permian, what does that indicate about the overall maturity of the basin itself?
How much easy oil is truly left to be extracted?
Exactly. And what happens to the global supply curve when water flooding becomes the industry baseline rather than the exception?
That is a critical question for anyone looking at the long-term horizon of domestic energy. That wraps up our analysis for today. Final verdict, 7 out of 10 bullish score.
Don't forget to subscribe to the channel.
Yes, subscribe, like, and comment to this video to support the show. We will catch you next time.